This is a really important video for me, and I'm hoping for all of the investors and those in the trading community on YouTube because I don't think it's really something that's been discussed often. Like I haven't found that much content about this specific topic. Obviously, there's a lot of get rich quick schemes on YouTube, right? Like make money off this indicator quickly, come on my private jet, join my swing trading club, all that type of stuff. It's everywhere. But I think it's time to go back to the basics and just remind anyone out there who wants to be a professional trader or professional investor about what your goal is. And if you can pass this test that I'm about to explain to you, you can be a professional investor or trader. Like this is the test you have to pass. If you can pass this test, you can be a professional investor or trader. So do you want to know what the test is? Because I'm about to tell you the test, and this is the test. Now, there's this little thing called the S&P 500. You've probably heard of it. In fact, you might be thinking, of course I know the S&P 500. I see headlines on all the time. I read about it all the time. I hold some S&P 500. All right, but you may not know it quite like this. So I'm going to go into the details about it. The S&P 500 holds 500 of the largest companies essentially based in America. 500 largest companies, one index. When you buy a piece of the S&P 500, you get a piece of those 500 companies. A small fraction is divided up amongst them all. It's not equally weighted though, right? The highest market cap company, more of your money goes toward that or how they weight it. The lowest market cap company or the lowest holding in the index, the smallest amount of money goes to that. But you get a piece of the 500 companies in this index. Then, when those 500 companies go up like this, well, so does your portfolio. And you're diversified across 500 companies. 500 companies. It's very diversified. It's really hard to just buy 500 companies. All right, now that we got that out of the way, let's talk about why this is the most important test for investors and traders. Because if you can't outperform this performance, you just simply may want to reevaluate if you're spending your time on the right things. Because as you know, a lot of people might be trading, let's say in this example, Uber, and you're on a 30-minute chart of Uber and you're just watching it all day and night. You're on your phone watching it all day and night. Dang it, I entered here. I'm down like 20 cents. This is painful, but it's my favorite company. Maybe this is support. It takes up a lot of mental energy. Maybe you also have a position, say in BTC USD, and it trades 24 hours a day. So you're literally on your phone 24 hours a day watching Bitcoin. Here's a trend line. Is it going to hold here or break? This means everything. It held here. I think it'll go here. It's a big part of my portfolio. You've got your alerts and alarms set. You're getting emails. And then sure enough, it breaks. And, if it does, that does suck. But the point is are you underperforming the S&P 500? Meaning, did you put all that time into markets just to underperform the S&P 500? Because that is your opportunity cost. That is everything about markets. If you can't outperform the S&P 500, you need to reevaluate because quite frankly, you could just buy this index. Let's go to actually, you know what? Let's go to a monthly chart to really show you. Look at this monthly chart. This shows you the performance of the S&P 500. How about over the last 25 years or so? Look at this. That is incredible. And the magic about these types of indexes is you don't even follow the markets really. The whole point of buying indexes is that you're so diversified that ideally you're just sort of enjoying this run up without spending much time on it. There's a lot of interesting stats and facts about this type of investing. Just low cost, long term, simple dollar cost averaging, in that the ironic thing about investing is that the less you do, the more you make. It's hilarious. It's the only industry where you could say that's true. Let's say you want to be a professional athlete. You have to work out like crazy. But do you see all of these gains here? This is just buy and hold, meaning buy it, log out, walk away. Those would have been your returns. The less you do, the better you almost would have performed. And so you want to make sure you're outperforming the S&P 500 index, or maybe your trading just doesn't make much sense. So for example, let's just say, you've got a big position in Coinbase, okay? You've got a large position in Coinbase. I'm going to run this comparison, click year to date. Let's see how Coinbase is doing relative to the S&P 500. I'm I'm going to change Coinbase to a blue line. That's their company colors after all. Make it a little bit thicker here. I'm going to change the S&P 500 here to a, let's actually first change this to a line chart. So it's just a very straightforward comparison, but the S&P 500 should be a white line. There we go. So now you got the S&P 500 in white and Coinbase in blue. And let's just say Coinbase is a big part of your portfolio in this example. And you've been reading every earnings report, following the breaking news, you've got your news feed set up. Well, you just did all that work and look at Coinbase's performance. It's up 8% this year, and the S&P 500 is up 19%. So you could have bought a piece of these 500 companies and been up 19%, or totally concentrated, you're trying to outperform the markets, you're up 8%. That is brutal. Like, the return on your time is just not great there. And so this is the test. Go see if you're outperforming the S&P 500 this year. If you're not, it's time to reevaluate, or maybe you want to give yourself more time. But this is the simple question that all traders or investors should be asking. Not if your strategy is up a little, not what's the get rich quick scheme, how am I going to make millions or gazillions? The first thing you have to ask is, can I outperform this magical massive index called the S&P 500? That's question number one. You have to figure out how to outperform this. Also, what's quite important here is, I'm just going to now pull up a video of Buffett, is that this is what all of the great investors do. They are all focused on outperforming the S&P 500. So Warren Buffett is, we all know him, probably the most famous investor ever. There will probably never be another one as famous as him. I'm going to do this in orange. He owns and operates Berkshire Hathaway. So I've added Berkshire Hathaway to this chart here, right up here. I made Berkshire Hathaway this orange line. So this orange line is Berkshire Hathaway. Now, Warren Buffett runs a huge company. It's, I want to say it's almost $1 trillion now in market cap. And it's a conglomerate. He owns many businesses underneath it. Now, when investors come to him and they want to give him his money at that size and scale, they have to ask themselves, do they want to invest with Buffett, or do they just want to buy the S&P 500 and relax, and in this case, be up 19% year to date? So Buffett needs to prove to them time and time again that he is a better operator, stock picker, manager than the S&P 500. Otherwise, there's no point in buying his stock compared to the S&P 500. So all of the greats go through this. All of the greats. Ray Dalio goes through this. Warren Buffett goes through this. Everyone you can think of in this legendary field goes through this, even the quants. So if you love a quantitative trader like Jim Simons, well, his quant fund needs to outperform the S&P 500 to have any type of staying power whatsoever. Now, these investors have done that. You can see Buffett's performance is the orange line. S&P 500 is the white line. Let's do 5 years. He's beating it over 5 years. Wow, look at that. Over the last year rolling, this might change quickly. He's underperforming. Year to date, though, he's doing quite well. That's awesome. So this is the first question. And I also want to layer in one more component to this, going back to the Coinbase example, which makes it even more brutal that Coinbase is underperforming the S&P 500. This is where things get really difficult. And I hope you've watched this long in the video, because you're going to get a very important key point here now as well. Not only is Coinbase underperforming the S&P 500, but look at the volatility. Ouch. So if you held Coinbase as maybe a core part of your portfolio, now your portfolio is underwater, you've gone through some enormous swings. And you can just see Coinbase at one point was down 20% on the year. Then it was up 70% on the year. Look at that, it was up 70%. Then it dropped back down to 25%. Then it climbed back up to up 70% on the year. Eventually, it dropped down to being negative on the year. Now it's up 8% on the year. Holy cow, that is a roller coaster ride. That's insane. To be down 20%, up 70%, down 6%, up just 8% over the year, and this is the number one position in your portfolio, it's how your portfolio is performing. Ouch, that is brutal. It's hard to make better decisions under that stress. You might not be sleeping great with that stress. Checking, all of the information all the time with these swings. Meanwhile, the S&P 500, look at this, just chugging along and relaxing, just enjoying its gentle, casual ride upward. And that is another very important opportunity cost to all of this is the volatility that you are enduring. And some people have a trade-off. For example, let's just say Coinbase before the year's over. So let me end on this really important note. Before the year is over, let's just say Coinbase eventually sort of climbs back up and it's up 30%. Let me make this a little bit better. It climbs back up to 30%. And the S&P 500 ends at 23%. So you would have made 7% more on Coinbase. But some people would argue, and there are equations, there's investors who believe in this, people who might allocate money to a fund believe in this. Was that 7% difference worth these volatile swings? At first glance, I haven't looked at the math, but at first glance, to me, it's not worth it because a lot of people might get stopped out here. They would have taken the loss. Once again, another way people might not have been able to handle it. Even from being up 70% and then drawing down to 25%, phones are ringing. Why didn't we sell at the 70%? What are we going to do? Oh no, do we buy more? What we should have sold? It's just that those types of headaches are brutal. Did you see their latest earnings report? It's going to shit. Get out, get out, get out. You know, they're barely up 17%. It's sometimes just not worth the headache. So even if your portfolio does outperform the S&P 500, this is my final point, this is now the other thing you have to ask yourself. Was the volatility that you endured, the news, the price action, the headaches, the fast movements, the countless trading action, worth the slight outperformance? That's why I would wager whenever the S&P 500, say, is up 19%, you actually probably want to aim to do 1.5 times it. So if it ends the year up 19%, you want to do 1.5 times that. It's pretty difficult, but if when people manage their own portfolios and hold 5, 10, 15, 20 positions, they're going to have oftentimes more volatility than the S&P 500. So you have to adjust for that with higher gains. So that's the point of this video. It is really just an educational lesson on the most important thing in markets. Put everything aside, get all that YouTube content out of the way about get rich quick, my indicator's the best, I'm the greatest, here's how to make tons of money, buy this stock, and just ask yourself this. Are you going to outperform the S&P 500, number one? Are you going to do it with a minimal amount of volatility, number two? And number three, with all the time that you spend constructing your strategy and portfolio, is it worth the outperformance that you actually do achieve when you could have just invested in an index, mutual fund, and walked away? So I hope this video helps. Very introductory level, but there's a lot of great traders out there who've been trading for 5, 10, even 15 years, and have forgotten about this basic question. So that's it. Hope you subscribe to my channel and like my content.